go, baby. All right, we're recording and we are live. So, welcome, guys. Lots of updates today. I did discuss quite a bit of these updates earlier. I told you guys about the ADP employment report, which was the private sector we're dealing with. Be interesting to see how it compares to the Friday government survey. We'll see what happens with it. I don't know why I'm forgetting the name of it. The non-farmer payroll report, that's on Friday. And remember, the non-farmer payroll comes out the first Friday of every month. So it just so happens that the first day of September is on Friday. So therefore, we're going to be getting the labor report this week. And so it'll be interesting to see, because when we're talking about the non-farmer payroll, we're going to include the public sector as well. So we're going to see how many government jobs were added as well. It's been looking at some of these previous jobs reports that we've had, and I don't think a lot of you guys get it, but a lot of these job gains that we've seen within the last 15 months has been because the government's hiring so many people. And I can go and break down those reports and tell you specifically which departments, specifically which areas they're doing all this hiring at, but it's tens of thousands of people every month, right? And this is because when you think about the private sector, when you think about private businesses, in order for private businesses to hire more people, the business has to do what? The business has to generate a profit, obviously. So if the business is not successful, it won't be able to hire more people and increase its productivity. Now, with the government, which the government jobs that people get don't produce anything at all. At least when you're working in the private sector, you're producing stuff. You're producing goods and services that are sold in the economy. But when you're working at a government job, they don't produce anything at all. These government jobs, they don't produce stuff, right? However, remember, I said in the private sector, the businesses are the ones paying for the labor. But when we're talking about the public sector, when people get hired to work at the government, who pays for those salaries? Who pays for all that stuff? Somebody tell me in the comments. I got Instagram Live here. Guys, who pays for that? Who pays the bill for these salaries? Apologize if I missed any of these questions here. I know that Tiffany said that people who live in Florida were soldiers because of the hurricane. We just don't really care. Yeah, prayers to all of you in Florida. Thank you so much, guys. I appreciate that. Luckily, I was able to stay out of the way. We pay. Yeah. Okay. Yes, exactly. So back to the public sector, right? When there's a lot of people being hired at the government, that has to be funded by taxpayer money, right? So that just goes into even more government spending, right? Now, the biggest thing that we want to really try to do is get the government to cut spending. It needs to be the other way around. We don't want to increase spending. We want to decrease spending. Well, actually, we want a couple of things. We want to decrease spending, yes, but the government has a spending problem. It's almost like a really nasty addiction, but they keep doing it over and over. And the other thing that we need to do besides cutting the spending is we need productivity to go up. Because if we're producing more goods and services, right? So there's two sides to the equation, right? There's supply and there's demand. This is the first thing you learn in not even college economics, but high school. This is like economics that you learn before you even get into college. Just your basic high school class. Supply and demand, right? When the supply of something goes up, what happens to the price? Okay, what happens to the price? Basic, guys. What happens to the price? When supply increases. All else equal, supply goes up. That means, that's right, prices can come down. That's the law of supply. But when there's something is more scarce, something's more rare, given that the demand doesn't change, the price can increase. Okay, so think about this. When supply goes down, prices increase, right? So if there are more people becoming unemployed, if people lose their jobs and they're no longer producing stuff, that means that our productivity goes down. We're not producing as much stuff. And when the production goes down and the supply is lower, given that the demand is the same, what happens? Prices go up. This is bad for inflation, right? So in order to see prices come down to counteract the effects of inflation, which are horrible right now. In order to do this, we need two different things. We need demand to come down and we need supply to go up. So we need to increase productivity. We need to get people out of the government jobs and we need to get them into the private sector, right? However, the private sector, as you guys know, is struggling. They're at a massive disadvantage right now. Why? Why is the private sector struggling? Because interest rates are so high, right? Now, historically, they're not high because, we've seen interest rates get much higher than they are now. And, besides the past couple decades where we've artificially had interest rates near 0%, if you look at history, just from a historical context, actually, the interest rates we have right now, 5.5%, is actually not that bad. It's actually not that high compared to historic rates. But anyway, it's a little bit different today because we're talking 5.5% interest when our government is $32.8 trillion in debt. Okay? Just the interest that's owed on that debt is massive. So if we're only bringing in $4 trillion a year in tax revenue and at a 5.5% interest rate on a $32 trillion national debt is basically $1.8 trillion. Well, we have 4.0 coming in, 1.8 going to interest. That leaves us with what? 2.2 trillion left for all the rest of the government spending. Oh, and when I'm talking about the national debt, I'm not including all of the other liabilities, like the Social Security liabilities, with all of that stuff added into it, the national debt is a lot closer to like 100 trillion. I was looking at the debt clock a little bit earlier today. I can't recall the exact number off the top of my head. So I think what I'll do, I'm going to take a look at it for you guys. We'll just take a look at the debt clock real quickly because I want you guys to know, because remember, we just eliminated the debt ceiling. We were going to raise it because the government had gone up to its borrowing limit and was about to default on its debt unless we allowed the government to go further into debt. But that just sounds a little wrong, doesn't it? Doesn't it sound weird that the only way we were able to prevent a financial crisis or a massive collapse in our economy is by allowing the government to go more in debt? In other words, if we didn't allow that to happen, if we told the government that they can't go further into debt, we would have defaulted and all of our foreign creditors would have taken massive losses. I mean, the credibility of the US dollar would have completely tanked. We would have had massive hyperinflation because if the dollar drops like that, okay, if the dollar like completely gives out, then the prices of everything will shoot way up, right? So that is a big thing that was avoided. I mean, at least for now, you never know. I mean, I think that eventually these foreign borrowers are no longer going to want our debt, especially when inflation starts to go higher. I talked a little bit on the last show about how I believe inflation has already hit a bottom. I think it's going to start going much higher than here. The last CPI we got was 3.2%. That was an increase from the prior month. So inflation is also going the wrong way. And when we listened to the Jackson Hole, Wyoming press conference with the chairman, Jerome Powell, he was repeating the same thing that he said over and over and over, which is inflation is too high. We still have more work to do. They're maintaining their 2% goal. A lot of people thought that the Fed was going to change the goal from 2% probably up to like 3%. But they didn't. They confirmed back on Friday, they threw a bunch of cold water on that idea by reinstating that their goal is still 2%. Now, I've been saying this forever, but what the Fed has done to try to get inflation down to 2% is not near enough. Raising interest rates to 5.5%, 525 to 550 basis points. That is not nearly enough. We need interest rates to go way higher if we actually want to get to 2%. If they were serious about it, they would raise the interest rates to 10%, 10, 12%, something like that. But they won't, because if they did that, it would cause massive issues. Okay, that's the whole problem, is that they can't get inflation down to 2%. If they did, it would cause too many issues. So they're trying to really pretend. I don't care how long they want to pretend that they can get inflation down to 2%. It's never going to happen. It's impossible. It's impossible for them to get inflation down to 2% because they're not willing to take the necessary action to get to 2%, because if they did, it would cause too many problems. And the Fed knows this. The Fed knows this, or else they would have just raised the rates, right? Because originally, when Jerome Powell said that they wanted to pause the rates, so remember, we have been raising interest rates every single 6 weeks for the past year or so, but then recently they decided not to raise the rates. They decided to pause instead and just keep them high, right? So they kept them high, but the thing is that they said, we're going to pause, but that doesn't necessarily mean that we're not going to raise them more. We're just going to pause for now. We're going to collect more data. We're going to figure out where we're at. And if it makes sense, then yes, we'll raise the rates again, right? That's pretty much what they were getting at. So in that case, well, why didn't they just raise the rates? Why did they wait? If they know that they're going to be raising rates anyways for another 25, possibly 50 basis points, then why wait? Well, it's because they're not very confident that it's not going to crash the economy. They know that they are walking on very, very thin ice, and they have to be very careful about the steps they make. They wouldn't be doing that because if they wanted to just get inflation to come down, they would just raise the rates, right? They wouldn't care. If the economy was that strong and that resilient, they would just raise the rates because it wouldn't be that bad. But the problem is that the Fed is pretending like the economy is strong, when in reality, when you look at their actions based on what they're actually doing, nothing about that says that they're confident. Nothing about pausing the rates and then also in the same breath saying that they want to potentially in the future go for another 25 or 50 basis points. Well, they would just do it right there if they felt that strongly. Why wouldn't they just raise? They know that they're going to raise rates. The only reason they wouldn't do it is because they're fearful. They're fearful that they might cause a huge recession, or even worse, I think that would be even worse. It would probably actually be more of a depression that would last a long time. And so they don't want to do that. They want to try to pretend like everything is fine and, oh, we just want more data. Well, why? Why do you need more data? We already know that inflation is too high. We already know that it's way off target. We know that it's nowhere near 2%. We know that we've been raising interest rates for 15 months and we still aren't to the goal, right? We know these things. All of these things are obvious. So I don't know why he's sitting here saying we need to assess, we need data, we need to assess. Why? What data do you need, right? Doesn't take a genius to know we need to do more tightening, okay? But he's not willing to do that because it'll cause problems, right? Last thing I want to wrap up here, guys. I talked a little bit about this on the last show, but the trade deficits are getting even worse. You know, I think I'm going to double check the actual numbers here. Let me head into the economic calendar. This is brought by MarketWatch. I like to use their economic calendar. It's very nice. So for those of you guys that like to look at, what economic events are coming up, check out MarketWatch. Just Google economic calendar, MarketWatch, should be able to find it. But the trade deficits last month were at $88.8 billion. The trade deficits for the month of July was $91.2 billion. So the trade deficit is even bigger this month than it was last month. Now, what does that tell you? All these trade deficits have to get financed somehow, right? Because again, we don't produce a lot of stuff. We consume a lot of stuff, but we don't produce a lot. So all this stuff that we consume has to come. Where is it coming from? It's coming from somewhere. It's coming from other countries who export it, right? So that's why we rely so much on imports. If all of these other countries just decided to cut us off from exports, what would we do? I mean, really, we would be in such a position of weakness. We could be easily overtaken. We're in a very weak position, and this is a big problem. We have got to be able to get this together. I mean, seriously, we're looking at going from $88.8 billion trade deficit last month to $91.2 billion trade deficit this month. It gets worse, right? And this is just showing that our productivity numbers are terrible. This is really bad for inflation because remember, we're very heavily dependent on exports. So if the US dollar starts dropping more and more from where it's at, then these imports are going to get very expensive. And all of those higher costs are going to be pushed onto who? Me, you, everybody listening. Everybody is going to suffer because of these huge trade deficits. So those numbers came out this morning as well. That was really crazy. Also, I think I did touch about this on my last show as well, but for those of you guys that didn't hear it, the GDP numbers were revised. The initial estimate showed a 2.4% growth in GDP, but the revisions, it actually was revised down to 2.1. So much lower economic growth than expected. So we're looking at 2.1 versus the actual, the original estimate was 2.4, but it was revised down to 2.1. So a little bit less economic activity than predicted. And that actually caused the markets to rally. Funny enough, you'd think that, well, if GDP was revised down, isn't that a bad thing? Why did the stock market go up? Well, this all goes into what the Fed is doing. Remember, if the Fed decides that there's all this weak economic data coming out, GDP is not as high as we thought, trade deficits are bigger. I actually have a theory that they don't really care about the trade deficits anymore or the budget deficits. They don't care about the debt because they'll just borrow or print more money forever. Like that's just what they're going to do. They're never going to pay back the debt. They're never going to pay it down. They're just going to create more money to get themselves out of it again. But this weak economic data that's coming out, the ADP report was weaker than expected. The GDP report was revised down. Yesterday, we had the JOLTS that came in at 8.8 million job openings versus the expected 9.5, so less job openings than expected. So all of this stuff, like all this weaker than expected data is, to the Fed, from their perspective, is do we really need to keep tightening more? Because we're already getting very weak data. We see that the economy is slowing. We see that there's less job openings. We see that less people got hired this month than what we expected. So all this weakness, what does that say to the Fed? Should they keep hiking? Maybe not. Maybe we pause right here. Maybe we just leave it at the 5.5%. We just let it coast, right? Now, of course, that's not going to work. It's not going to get inflation down to 2%. Like I said, it's got to be much higher than 5.5%. But that would cause too many issues, right? So they're really trying to see, can they get away with just a little bit, not really moving the interest rates that much more? That's what they're trying to see. And that's what investors are bullish on. Investors are bullish on the fact that the Fed won't have to raise rates anymore. The Fed can kind of coast and then eventually start cutting rates. So these markets are betting on the Fed controlling inflation and then therefore cutting rates back down closer to 2% again, and then below that. But I don't think that they're going to have to cut inflation or cut rates because of inflation. I think they're going to have to cut rates because there's issues, and they have to cut the rates to get the economy stimulated again because we're going to be heading in a really bad direction. So anyway, those are the updates for today, guys. We got more stuff coming tomorrow, so I hope you guys stay tuned. We got a lot of stuff coming up, so I'm excited to share it with you guys. But anyways, thank you so much for tuning in, guys. I hope you learned a lot. A lot more updates to come as well, so do not miss out on another episode. Make sure you guys download it, subscribe, save, all that good stuff. I'll see you guys on the next episode. Take it easy.